Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Larry Reaugh is CEO of American Manganese. He's online at AmericanManganeseInc.com. Larry has almost 50 years experience in the mining business, so we're always glad to hear what he has to say about what's going on. Hey, Larry, it's good to have you back on This Week in Money.
Well, glad to be here, Phil.
Got a couple of reports out that we should look at. A couple of the great ones here from Ernst & Young. The Canadian Mining Eye for the first quarter's out. Here's a prophetic headline for you. Headwinds continue. They're saying Canadian mining stocks continuing to underperform. There's a lot of concern about economic growth and commodity prices. One of the biggest things here, Larry, the biggest problem facing miners, raising capital. Boy, it is harder than ever these days.
Well, I've been raising capital for over 30 years, and I've raised well in excess of $300 million. And I've never seen it, the only time I've seen it this bad or close to this bad was after Reaugh. But this is even worse, and, to raise even a few $100,000 is like pulling teeth out there.
It is hard enough for major companies to raise capital. What about the guys who are really taking a pounding here, the juniors? It must be extremely difficult for these guys to get going here.
Well, we've been trying different avenues for months now, Phil, to get people interested. People are interested initially because of the project. They like the project. But when you're talking about a convertible or a debt finance, and they really want you to have assets that they can, tie down to forward the money to you. And if you don't have that, then they're really not interested in the equity. They're looking for a safe bet because they're uncertain themselves.
We're talking about the Ernst & Young Canadian Mining Eye Report with Larry Reaugh from AmericanManganeseInc.com. One of the things they're pointing out, Canadian companies operating in emerging markets are having a real problem with cash flow.
Well, the costs are actually have escalated in some cases beyond the prices of the commodities, and gold being one of them. And, over the last 10 years, we've seen a gold price that's moving north constantly. I think that probably, brought a little relaxation into the operation of these mines. That could add a little to the extra cost. But really the inflation that's been hidden from everybody is really showing up in the mining industry. I mean, capital costs have gone up 3-4 times. The operating costs have gone up beyond the price of the metal. But, that's a good news, bad news story. Basically, no company can operate at losses for any length of time. It's the old good news, bad news story of a company that says, well, we just produced an extra 1 million ounces this year. And they say, hey, that's great news. Yeah, but there's some bad news with it. And I say, what's that? And they say, well, we're losing $200 an ounce. So those are the sorts of things that we're facing today. And it's just a matter of companies are going to focus now on their production, try to get the costs down, things that they can have some kind of a control over. And they're probably going to see less and less big mergers or less and less big projects being attempted at this time.
Larry, not one but two reports this week from the folks at Ernst & Young about mining in Canada. The second one called Business Risks Facing Mining and Metals. And here's an interesting number. Capital allocation, access to capital at the top of the list. That's up from number 8 last year, a big jump.
Oh, yes. It's the capital. People have had, disconcerting experiences on overruns on budgets, right?
Mm-hmm.
And we've seen some, near fatalities or fatalities in that regard. And, so capital is being very cautious about, putting any money up for any future production unless they can totally control the cash flow the company has in order to make sure they get paid back.
This Ernst & Young report also identifying the sell-off in equity markets. It has reduced capital for juniors to levels that Ernst & Young folks haven't seen in 10 years. That is scary.
Well, this is a real anomaly that nobody seems to focus on. And, watching markets and watching specifically my own market where I had a very wide distribution of shareholders, the biggest distribution of shareholders I've ever had in American Manganese. And yet the stock keeps coming out like I've got 10 large holders in there. My guess is it wasn't real stock. This is high-frequency trading and people were playing the short side of the junior market, and they just ground these companies into ash.
Now, we know what high-frequency trading does on the big board. What does it do to juniors?
Well, they box you into a narrow trading range, especially if you have real buyers in there. The direction is down. It's more. In the last 2 years, it's been the best bet's been to short the stock, because you don't have to have the uptick. You don't have that uptick rule anymore, and I think that was that was really what's killed off the junior exchanges. You don't have to have an uptick to sell the stock. You can just keep selling it as it goes down.
Okay.
And you don't have to own it to sell it.
Here's an amazing number, Larry, from the Ernst & Young report. Companies with a market value of less than $2 million, that's about 20% of the juniors, had on average less than $1 million in cash at the end of last year.
Well, I'd say probably that number, 20%, is probably optimistic. I think it's probably greater than that. My checking around to see how my peers are doing, I see gold companies with a couple of million ounces of 43-101 resources, indicated and inferred, trading at $0.015, and I think a couple of million ounces when I first started in this business was a world-class deposit, right? And now it's absolutely has no value in the eyes of the investors. So, how does that happen? I mean, if you'd asked me 2 years ago if that could have happened, I would have said, there's no way it will ever happen. It's never happened before. It shouldn't be happening now. But if we remember 2008, when the commodity prices dove, I mean, we're still looking at $3.20 copper. We're still looking at close to $1,400 gold. And, but the commodity prices dove, specifically copper, down to about $1.25 to $1.30 in 2008. That's way under the actual operating costs of most copper mines out there. And, you look at that and you say, well, what was going to happen? What was going to happen was you're going to have a lot of mine bankruptcies if it carried on for another 6 months. But the price snapped back, and everybody was saved. And, remember Teck Cominco was down at less than $4 for a while. And, then it went back up to 48. Now it's down to about 24. So, it's a dicey market. As far as I'm concerned, we're still in a bull. No matter what they say about China's demand, I mean, 7% of a much bigger GMP is a lot better than 10% of a GNP that China had 5 years ago. And that means that there's still going to be that demand for the metals. What's happening really is everybody's looking at the demand. They're not looking at the supply, and the supply is going to diminish rapidly over the next year as mines are actually probably going to have to shut down, and there's certainly not going to be a lot of projects are out of the pipeline. And, so we have, then the Bingham Canyon slide takes a lot of copper off the, copper moly off the scene. Certainly what's happening at Freeport is, putting a lot of, taking a lot of copper offline and gold. So all these things don't seem to have a positive effect. Growing up in the mining industry, those things used to have a very, very, very positive effect on the price of the equities.
Larry Reaugh is CEO of American Manganese. He's online at AmericanManganeseInc.com. Hey, we got another report here, Larry. The latest Price Waterhouse Coopers report on the mining sector is out. Mine 2013, a confidence crisis. Here's the executive summary. Mining companies continue to experience a disconnect as revenues remain flat, profits fall, share prices underperforming.
Yes, that's the headline news today. If Phil, if you look around, you'll see that it seems like bad news is much more published out there than good news when it comes to commodity industry, or certainly any other industry for that matter. But the reality is that nobody knows. Nobody has a crystal ball. Nobody knows when this thing's going to turn. Is all we can go on is past experience and say maybe the regulators will, lighten up a bit these environmental regulations. And I'm not poo-pooing environmental regulations. I think they're necessary, and I think most companies do their best to meet those types of regulations. But the costs that are being put onto the new projects and the older projects on upgrading is affecting the what they can what their profit line is going to be.
One thing we don't think about, Larry, much when we talk about mining is the regulatory process, both here and in other countries around the world. Let's focus on Canada. Any big changes coming?
Well, I think there should be. All I see is more proposals to hurt the junior industry. And but I think there should be. When I started in this business, our financials were, I think 4 pages or 5 pages long, and prepared by management for all the quarters, and then with the audited financials at the end of the year. But now we've got a book that we publish. Most people don't read it. If I look at my site and I look at the financial sections, the hits are less than 1%.
Yeah.
And but the costs, that layered a cost of extra overhead on the companies now that could have been a good drill program 15 years ago, 20 years ago.
Larry Reaugh, our guest here on This Week in Money. Let's look at a little bit of mining news here. Interesting developments with a couple of the majors here. Kinross, the 5th largest gold producer, walking away from its gold project in Ecuador. They spent 5 years and $1 billion to acquire this project and weren't happy with the windfall tax that the Ecuadorian government wanted to impose on them. So something like 70% tax.
This is crazy. We went through this in 1973 with the NDP government here in BC when they had what they called the super royalty tax. Every major company over the next 3 to 4 years or 5 years, I know because I was in the drill business at that time and I watched my contracts drying up, and they pretty much left the province and basically stayed out until recently. They've started to come back. So any country that's putting these super royalties and heavy taxation on mining is looking at for people like Kinross to abandon the project. Why would they stay with a project that they're going to see nothing at the end of the day? They have to take the write-off, and they have to leave. You just have to decide. And Phil, this is not just Ecuador. This is happening everywhere. Like in Venezuela. There's situations going on where people use the Environmental Act itself to, boot people out of the country, to take over projects. It's just very, very risky anywhere in the world, South Africa, South America, even in Europe. And we got to stick with, I think probably the safest jurisdictions is Canada.
Yeah. With
the U.S. second, but the U.S. is really shooting itself in the foot when it's on the Preble project. They're going to circumvent a few $100 million spent on environmental studies and put out a study that I can't imagine because it's a what if scenario that probably cost in the low millions, and they want to kill the project, and that's that's given a message out there that we really don't want to hear in the United States. That that the environmental concerns can kill a project before it's even gone through due process.
Larry, tough enough for miners, but where does all this leave investors? I mean, you look at some of these numbers here. Year-to-date, Goldcorp down 20%, Newmont down 30%, Silver Wheaton down 35%, Barrick down over 40%, and the slide shows no sign of abating. What do we do here as investors?
Well, you look to pick your bottoms, and, we never can pick the exact bottom. We can never pick the exact top. And so you have to say, what's a company worth? And when it gets down to where you think the value is, then you step up and you buy the company, because sooner or later the whole world will recognize that value is at a certain level, right? But as long as we know that emotions run the market. It's fear and greed, and as long as the fear is out there, then you pick your spots. And but we don't know when that's going to run out. Certainly, a topping out on the big board may focus more attention on mining again, and that could be a boon for us rather than the big ship pulling down all the other ships. People may look at this as an alternative investment where we actually deal with hard material and have real value in the ground, real value in the pipeline, and real value on the books. So I do see that that this isn't going to last forever, and I'm thinking that this fall we'll see a pretty good market.
Larry Reaugh, CEO of American Manganese. Check out his website, AmericanManganeseInc.com. Hey, Larry, thanks for this.
Thank you, Phil.
This Week in Money is archived online at TalkDigitalNetwork.com.
David Skarica is author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. Visit him at addictedtoprofits.net. Hey, Dave, it's good to have you back here on This Week in Money.
Yeah, it's really great to be here.
Dave, they're calling it a modest gain for gold this week, up almost $10, still below $1,400. The market nervous about the Fed tapering off stimulus. Bernanke news conference next week. We're going to see if that does anything for the price, but there's some good news in all this. You say we are nearing a major bottom in gold.
Yeah, I've done a lot of historical studies. Now, this goes on where I think we are in the long-term cycle. And in the long term, I think that long-term, I mean like the next 5 to 10 years, I think that we're still in the middle of this quote-unquote super cycle in commodities and precious metals. And actually, the fact that so many are saying the super cycle is done is actually, being a contrarian, I like that. So what I think is if you look at gold in 1970 and in 1976, there were about 60% declines in the precious metal stocks as the markets kind of had these counter moves upward. And then, of course, we had a 70% decline in 2008 in gold stocks during the financial crisis, and we've had about a 61% drop in the HUI, the Amex Gold Bucks Index of large cap gold stocks recently. So, as difficult as this may be, there's historical precedent in this that we get these 50, 60, 70% declines while the stocks are still in the context of long-term secular uptrends, and you actually want to buy these declines. And so that's kind of where we are at the moment. So I think that this is just again, it seems difficult because everything's been declining for roughly 2 years since 2011, and we're talking about stuff 50, 60, 70% off the high. But there's historical precedent for this, and gold stocks are very volatile equities. So I think we're in a great buying opportunity here within the secular uptrend.
Let's talk about the miners for a second. We were talking to Larry Reaugh earlier in the show about the huge sell-off among the big miners. Here's Goldcorp, year-to-date, down 20%. Newmont, down 30%. Barrick, down 45%. Are we near the bottom for these guys, you think?
Yeah, actually, if we look at something like Barrick, for example, Barrick is actually down 60% from its all-time high.
Wow.
Its high is about $50 a share, and it's about $20 as we're speaking here today. So, yeah, I think, look, it's not just the gold price. It's not just an overreaction. Some of these companies have done a very poor job of management and controlling costs, going to mega projects to replace declining reserves. And those projects, some of them not even going into production right now, having environmental issues. Some of them going way over cost and producing less than they thought. So, yeah, just very, very, very difficult, right? And so I think that some of it is internal issues. That's the reason these stocks have really lagged. But the good news is this. They've written off a lot of these costs. They've written off the value of a lot of these mines because now there's a lower gold price. So the kind of bad news is baked into the cake. And again, if you take the gold stocks, you talk about Barrick and Newmont being down, divided by the price of gold, if you go to the historical average towards the price of gold, these stocks are undervalued by maybe 20, 30, 40% of $1,400 gold. So we're seeing very cheap equities right now within the context. And if you want to look at like some money pouring into it, there's a recent article and something I talked about in my recent newsletter that George Soros actually took some of his GDXJ position, which is like a junior mining, a smaller producer ETF in the United States. He took some of this position, sold it, but then turned around and put that money into call options to get more leveraged on it, feeling quite confident that there is a turnaround in gold and gold stocks. And actually myself, today, I bought some of the kind of higher cost producers that are really struggled because, again, if we turn around, we're going to have more leverage in those kind of companies right now. Now, those are the kind of companies that if gold goes to 1,000, would probably go under. But if gold turns around here, they're also the kind of things that, forget about just doubling or tripling, these could be 5 or even 10 baggers.
Now, George Soros is a pretty smart guy. Tell us what he's been doing and what that says about what we should do. How can we be more Soros-like in our investing strategy?
A lot was made of that he sold his GDL position. Now, there's one rumor that he actually took some physical delivery, meaning that he actually turned that GLD into physical gold. But forget about that. He sold about 10%, or say got rid of 10% of his GLD position, regardless of what he did with that 10%. And then he actually increased his position on the miners in the GDX, in like I said, these call options on the GDXJ. And I think it just shows you that he believes that the leverage is in the gold miners. He believes that he believes in something called reflexivity, and that just basically says that markets are reflexive. And what that means is that markets overshoot to the upside and overshoot to the downside. So he obviously thinks that the gold miners have overshot to the downside right now, and probably that's where the leverage will come as they become reflexive and go back to their, say, traditional valuation metrics. They're going to outperform to the upside. And right now on the technical charts, and I use technicals less and less now because I am kind of a contrarian value investor, but I still use it to kind of confirm what I'm doing. And if you look at a chart of the GDXJ or the chart of the HUI index, it looks like we're putting in reverse head and shoulders on the chart pattern right now, with shoulders being in about the 250 to 260 area on the HUI and the head being the 246 bottom that we saw in late May. So I think that everything's kind of forming. And then, remember I talked about the crashes earlier?
Yeah.
76, 2008. And if you look at 1987 in the general stock market after the crash, what usually happens when you're in a crash, but you're still within the confines of a secular uptrend, meaning the long-term trend is still up, after that crash, there's about a 3 to 4 month basing period, and we crashed in April, so we're about 2 months into it. So we could still see another month or two of basing in the gold stocks and gold equities, which is probably the time frame that you still want to get in. And then after that basing period, and as the bearish sentiment builds, as the short positions build, then we'll come out of it to the upside and really begin to move. So I think that everything's lining up from the valuation perspective, from the sentiment perspective, from how these cycles usually trade. I think everything's building up for these kind of stocks or these kind of equities to really, really move higher in the coming weeks and years.
David Skarica from AddictedToProfits.net, our guest here on This Week in Money. Dave, what about the disconnect that we've been seeing all along between miners and gold? Is that going to narrow over the summertime and fall?
Well, I think one of the scenarios I've read out, and this was someone I was talking to who was very, very connected in the hedge fund industry around the world. And he told me that he was going to Asia and places like, financial centers like Dubai in Asia, and saying a lot of the fund managers have begun to put this trade on, especially the momentum guys, where they're actually long the stock market and short the gold equities in kind of this counter trade. And I think that if you're a believer like I am, that the stock market is making a major top here and it will roll over. And now, because of the sell-off in the gold equities, we're not going to see this risk-on trade like in 2009, 2010, where gold stocks traded higher with the market. I think now we'll see the gold equities trade higher with the stock market lower. And that's compounded with this fact that people are long the S&P and short gold stock. That's going to really help the gold equity to the upside if the stock market kind of rolls over. So I think that's why you might see this thing where the gold market itself, really at 1,400 gold, we're not really that bad. And even off the bounce off the lows, we haven't seen a big rally in the gold equities. That if the stock market is in a period of topping here, we could see the gold stocks begin to significantly move higher. And on this last crash, there has been significant higher short positions entered. So again, all you need is a rally of 5, 10, 20% in some of these stocks, and then you'll really see the short covering kind of kick in right now. And like I said, I'm more inclined is on the large caps, the stocks you're talking about, like Newmont and Barrick. I actually would be more inclined to do what Soros is doing, like on the GXJ, buy some call options or write some puts on those stocks. And then on the smaller miners is where you're going to want to place your positions, because they're the ones that have the leverage. Now you have to have some real to do that right now, because again, the smaller miners also have the negative context where if gold drops another 10 or 20%, a lot of them could go under, but they're also where the leverage lies right now.
David, this is probably a good time to ask you about subscribing to your newsletter.
Yeah, if you go to addictedtoprofits.net, we're actually just in the midst of redesigning the site. That should be done by the end of the month, by early July.
Okay.
And I'm going to have some special offers coming up, but go to addictedtoprofits.net and sign up for my free letter. I post interviews like these here, and I give kind of sample articles of my material. And right now, actually, we just did 2 issues, one on why the market's topping, another one why the gold industries and precious metals are probably bottoming, more informational type issues. And now I'm following this up with issues on where I think you should be in the market.
Okay.
Where what equities, what actual investments I really like at the moment. So again, sign up to that, and then when we do an offer, you can subscribe to the newsletter and get reports such as those.
David Skarica, author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. Visit Dave at addictedtoprofits.net. Hey, Dave, it's always fun. Thanks for talking to us.
Yeah, thanks for having me.
This Week in Money is archived online at talkdigitalnetwork.com.
Bob Hoye is Chief Financial Strategist for Institutional Advisors, and Bob writes Pivotal Events. It's a weekly overview. You can find out much more at institutionaladvisors.com. Bob, it's good to have you back on This Week in Money.
Well, it's always good to be here. It's always good to be anywhere.
Thank you for coming along. Hey, nothing cheers up a gloomy Friday better than some fresh economic data. We got a bunch of it for you this week with, of course, the usual mix of good news and bad news. Let's start off with the good news. The number of Americans filing new claims for jobless benefits falling last week. Its lowest level in 5 years. They're saying it's a sign of resilience for the U.S. labor market.
Well, those labor numbers, they come out there. I can't, I've been in the business for decades, and I can't figure out what they're talking about because they got unemployment. Then they got the numbers that might be employed if they were employed, and then they've got those who are giving up looking. I mean, unemployment is unusually high. Let's just put it that way. And if they've had one good news tick recently, it's fine, so.
Got to balance that off with some bad news. The Thomson Reuters University of Michigan Consumer Sentiment Index just out. It fell to 82.7 in June. That's below a 6-year high of 84.5 in May. Economists, as always, are surprised. They wanted it to hold the line, but it fell somewhat.
So they didn't get the direction right. But then, what was it, 2 or 3 weeks ago when the Conference Board big consumer sentiment thing came out, and it was very positive. So maybe the consumer sentiment is as volatile as the big stock market is.
Well, that's affecting the big stock market. Stocks in New York are sliding a little bit today. Not really much action, but everybody talking this week about U.S. monetary policy. Which way are they going, and how's that going to affect the markets?
Well, they are that, but the buzz phrase for it now is the taper. They're going to taper off on the amount of bonds they've been buying. But our view, and I think we mentioned it a week or so ago, and I know I wrote it about 3 weeks ago, was that I think the market forces are going to preempt the Fed's decision to keep buying bonds or the rate at which they buy bonds. It reminded of back in the Bretton Woods Agreement when the currencies were pegged to the U.S. dollar. And then different countries thought that they were safe with that and could go about, reckless spending policies. And then they used to call them then the gnomes of Zurich. The guys in the banks there would watch. Now, here was a one-way shot. You could just short the currency knowing at some time they wouldn't drive it any higher because it was pegged.
Good plan.
And then it's going to fail.
Okay.
So what that did is, and then of course in those days you'd have a finance minister he'd be asked, maybe the financial conditions were becoming a little precarious, and they would ask, well, you're going to devalue? Oh, no, of course they wouldn't. And the next day, then it's official, and they would devalue. But I think they were just getting in line with market forces, and this is what I think about this great to do about the European Central Bank buying bonds and the Fed buying bonds, and everybody knowing that you cannot do that forever. But they have this really strange idea that if they do it for a little while, it'll pulse things and change financial history. I don't think so.
All of this, of course, affecting the markets. The Dow swinging more than 100 points during 7 out of the 8 trading days so far in June.
And then, as we noted last week, the buoyant Tuesdays came to an end. Whoom, hard. So we're into, Phil, it's a new paradigm.
Certainly a new paradigm in Asia. Bank of Japan earlier this week said they weren't going to do really much more stimulus. That shook the Japanese market down 6%. It's back up today, but China and Singapore are slumping as well.
Well, that was that. The Nikkei was down 6% in one day. But then it had, maybe 4 or 5% days on the way up. But again, that was that radical debate, drop in the yen,
mm-hmm.
and then that, of course, set off all kinds of stock rallies in Tokyo, and I think that's been reverberating around the world here. And then, of course, they can't do it every day. They got to back off somewhere, and now they got hit hard. So. Extreme violence.
Big shock in Greece. Speaking of extreme violence, the Greek stock market downgraded to emerging market status and a 12% loss for the week. Wow.
Ooh.
Yeah.
That's painful. And we did see here, the hit to the bond market just went on and on. Again, that was the market forces preempting the Fed's desire to buy bonds and keep things happy. So it got hit hard. And then a few days ago, they were talking about disorderly bond markets. Well, we thought that the excitement in April in the bond market was incredible. And that set us up into the dangerous season of May, where if you have a hot credit market going into May, oftentimes there can be a reversal and then turning around for a while, and then into, because it's a cyclical change, and then into the dislocated market in the fall. Or the term is used as disorderly markets.
Okay.
And you know what that, Phil, is? It's polite for a crash. Disorderly.
Now, you used the phrase earlier on, monster sell-off. Have you seen this kind of thing before? And what's this big bond sell-off telling us?
And the fascinating thing is how quickly they can turn from positive one day to all of a sudden very negative the next day. So we've had that. Now, the word is out that it's a disorderly market, and but I think now that is in the market. So maybe a little stability in the bond markets. Of course, with the bond markets going, you had a jump in mortgage rates, and then you had a pretty heavy hit to forestry stocks and some housing stocks and real estate stocks. So they became a little oversold. So I think you can have a little rebound or some stability in the side that got beat up the worst. And they look like, yesterday was a pretty good day, but as we were talking about, with the Dow down 70 today, it's going the other way.
Yeah.
So, but the important thing, Phil, is that the credit markets have had their seasonal reversal. The hit has been initially way more severe than we thought was possible. We knew it would get hit, but this has been a good one. And then that's set up now for a great financial storm, say after September, or maybe middle of September it could start.
Bob Hoye from institutionaladvisors.com, our guest here on This Week in Money. And one of the things that you taught me to watch over the last couple of years, the grains, the GKX, the grains index. What's it doing, and what does that tell us about market conditions generally?
Yeah, well, they've been weak. You remember last summer, from July and August, they developed a terrible drought. I think it was the worst drought in U.S. in 50 years, and that drove the grains up. It was a really good market, and they rallied very smartly up to 533 in July, and that was when everybody thought it would run forever. But it became overbought, and then gradually this thing has just stair-stepped all the way down until a low of 413 on that index in April. And it looked like it might be trying to base in here for maybe a rally. You don't know how this season's crops are going to be. But then in the last week, bang, it got hit down to 396. And the low last June before the big drought rally started was 381. So this is very close to taking out that important low of last year, in which case that would set a cyclical bear market for the grains from in May of 2011. Now, going back to there is when we had that signal from our momentum peak indicator where it soared right up, and the hot action was in the commodities, and base metals had a good peak there. And then at the 1st of May, the base metal index went to a new low for the move that began in first part of 2011. So that then set a cyclical bear market. And without that drought rally last summer, quite likely the grains would already be in a cyclical bear market.
Okay.
But now, with this week's failure, looks like it's getting close to that. So the way we look at this is you had the big high for commodities in 2007, 2008 with the big bubble, and then the crash in virtually everything then, and then you've had now the first business recovery out of the crash in 2009, so it's now out of 4 years, which is probably enough. And you've got weakness in global commodities, which is saying that the business cycle overall is pretty slow. So we think that the cyclical bear market for commodities will continue for a while. And then also in the U.S., I think their economy is getting close to rolling over.
Okay.
So, it's not particularly attractive around the world, that basis, as far as economic activity goes. Then you have the problem of servicing not just all the debt that was taken on voluntarily in the bubble that ended in 2008, but you've had the coercive debt that the central bankers have with all of their stimulus, and it's actually that's coercive, it's involuntary, because that's the taxpayers on the line, whereby the central planners have taken the taxpayers' future earnings and bet it on the fact that they could make the markets a whole lot better. And the crash in bond markets in the last month is saying, no, guys, that you can't do that anymore. So, unfortunately, the outlook isn't so good there.
Bob Hoye with us on This Week in Money and gold. Let's talk about what's happening with our favorite shiny metal, moving sideways for the last couple of weeks.
Yeah,
still under 1,400. What's going on here?
Well, you've got the two aspects in gold. In dollar terms, everybody follows it in U.S. dollar terms, and you've got the real price, and it's been down as well. So, but you had a 10-year bull market that peaked in 2011, and then you've had a long contraction, and then in March, April, this huge disaster, forced selling the whole thing, but it got some very oversold readings, more or less opposite to the overboughts you were getting in 2011 and then last September. So the gold sector is oversold and disastrous, as the big stock market was overbought and excited, and these are opposites. So we think that they can go the other way, and so we would be buying gold stocks on the bad days. And, of course, the advice on the stock market has been sell on the rallies. And so it's nerve-wracking when you're on one of these big bottoms for the gold sector, but it's there, and we're looking for the opposite action, which is what we're getting here today. You've got an up for the gold, silver, and the gold stocks and silver stocks at the same time as the Dow and the S&P. The big board is getting hit. So we think there's opportunity here.
Got a question here, Bob, from Patrick Montford, who asks if you can clarify your position on the nominal price of gold in U.S. dollars. Says recently you wrote that a major peak hit in August of 2011 with the Momentum Peak Forecaster. Then you state the investment demand for gold is going to soar. I've heard the description on the real price, but these 2 points seem to contradict.
Yeah, I guess so, but let's put it this way. I think people focus too much on the dollar price of gold, which has been coming down. But also in the business cycle, in the up part of the business cycle, there's a greater demand for base metals and that sort of stuff, and energy, and that goes up. And usually in a business recovery expansion, no matter how weak it is, which this one has been weak, those prices will rise faster than the price of gold does, and then their costs go up, so it impairs their earnings ability and contributed to the decline in the gold sector. So, but what one wants to and then the other question included the increase in investment demand. Well, the way that works is that when you're going into financial storm, the careful money goes to the most liquid items, which is U.S. Treasury bills and gold. So, but when you had that big peak in 2011 in the whole gold sector, and then the secondary peak in September, then you had, well, let's face it, the inflation bugs in gold came out because their story was not working, and their amount of liquidation overwhelmed the odd scary time when the investment demand would increase for gold. But I think that the decks have been cleared in the gold market now, and it should be favorable for them, because into a financial storm, of which the crash of the bond market has said is coming, people are going to buy gold. The investment demand will increase, and we should see the base metals, grains, crude oil all falling, and that would be relative to gold. So then that gets back into the real price, which is it's improving. It helps the profit margins of the gold producers, and then also as the real price goes up, it helps calculating ore reserves. It just makes things a whole lot better. So it may be confusing as we work our way through it, but the main thing is that we're going into a financial storm that will increase the investment demand for gold, and we're also looking for this opposite part whereby, like today, we've got an up in gold and silver, and a down in the stock market. Okay. But keep in mind, Phil, that at any time when they're really going to hit the big stock market hard, that'll bring the gold stocks down. But you get a period of time when the dollar is steady to rising a little, and the investment demand for increasing for gold, the real price will go up. It'll help the stock. So net, say a year or so from now, the gold stocks should be very much higher than they are now. And net, after some ups and downs, the S&P type, the big senior stocks, will be very much lower.
Thanks to our guests, Larry Reaugh, David Skarica, and Bob Hoye. And thank you for listening. I'm Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.